The US Federal Reserve announced its monetary policy after a 2-day meet post-Indian market hours on Wednesday. The development comes at a time when war clouds over Russia and Ukraine have intensified and impacted several key commodity prices, especially that of crude oil. The US has been battling a spike in inflation that hit 7.9% in February, a 4-decade high. The consumer price index has not been the highest since January 1982, when it hit 8.4% amid a recession. In this backdrop, most analysts expect the US Central Bank to hike aggressively over the next few months and see up to 7 hikes in 2022, starting with a 25 basis point hike in March. Markets, they said, are pricing this in at the current levels. Aaron Captain of investment bank UBS expects US Fed to start hiking rates by 25 BPS increments in March at every meeting until November this year, before taking a pause. So will this aggressive US central bank policy action weigh heavily on the global equity markets amid the geopolitical concerns, and how is India likely to perform? Here's a bit of history. In 2017 and 2018, the US Fed opted for aggressive rate hikes. If we look at the performance of US indices for the cumulative period of 2017 and 2018, when the rate hike was 175 basis points, the US equity market still ended a winner. Analysts believe a strong US and global economy matters most for markets to stay buoyant. The rate hikes could bring in volatility with some downward bias, but it will not create any major fall in the Indian equity markets, says G. Chokalingam of Economics Research. But this time is a bit different. The geopolitical tensions have spilled over the heightened inflation, with Brent crude oil prices soaring to over $140 a barrel. Though they have cooled off since then to $100 a barrel, the inflation risk still remains. With the European Central Bank ready to wind down asset purchases sooner than expected and global central banks set to hike interest rates, can India afford to be the lone wolf in the pack? Here's what Devanshu Datta, an independent market analyst, says on whether the RBI will follow its peers in hiking rates and the impact this move can have on the Indian markets.
The impact on India is likely to be negative regardless of what the Fed does, because Indian macros have obviously been affected pretty badly. We are an energy deficient nation. We have to import fuels no matter what they cost. And inflation is a fairly serious problem now, because of also not just because of fuels, but also because of supply chain disruptions. And if the Fed raises rates, I think the RBI will be more or less forced to raise rates in order to protect the rupee. It can't really let the rupee free fall, because then your trade deficit goes out of control. There's already a run on reserves. India has plenty of reserves, but a lot of those reserves consist of hot money, which is coming through the FPI route, and the FPI's selling has been consistent and continuous for a period of many months now.
The market will remain closed on Friday on account of Holi.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.